Hi, this is John Prasinos, Editorial Director of Investing Daily, with the video presentation for Tuesday, January 4. To view our full range of publications and trading services, visit our website at investingdaily.com. Also visit the website of our subsidiary, streetauthority.com. The year 2021 was a challenging time amid a persistent pandemic, rising inflation, and toxic politics. What's more, the Federal Reserve is set to hike interest rates this year, perhaps as many as 3 times. Throughout 2021, the Fed pumped liquidity into the markets to keep equities afloat. This year, the central bank is taking a more hawkish stance, which has investors uneasy. And yet, as my favorite crooner famously sang, it was a very good year. If you had listened to the naysayers in 2021 and played it too safe, you would have left a lot of money on the table. Now that the books have closed on 2021, we can say that the S&P 500 racked up its 6th best performance last year in more than 30 years. Take a look at the following chart. The S&P 500 closed 70 days at all-time highs in 2021, nearly beating the record of 77 days that was set in 1995. Despite the drama of the daily news headlines, the S&P 500 last year never posted a pullback in excess of 5%. The 2 best performing asset classes in 2021 were U.S.-based large caps, 29%, and commodities, 27%. The worst performing last year were emerging market equities, minus 3%, and international bonds, minus 7%. Growth stocks narrowly beat value. On the sector level, energy led the pack as oil prices soared. The following chart breaks down 2021 performance according to the 11 S&P 500 sectors. Take a look. Financials benefited early in 2021 as the yield curve steepened and economic recovery accelerated. Technology was boosted by the resilient leadership of the mega-cap Silicon Valley names. Defensive sectors, e.g. utilities and consumer staples, lagged but nonetheless did well. Trading in the final week of the year was muted with modest losses, but the week capped another banner year for stocks. Take a look. Robust consumer demand, economic reopening, and a dovish Federal Reserve fueled last year's gains. Stocks also were kept afloat by extremely low yields on Treasury bonds, particularly the 10-year yield, which has held to about 1.5%. Polls show that most Americans view the economy as terrible and getting worse, but this perception is divorced from reality. The economy is actually growing and should pick up steam in 2022. However, inflation and the drumbeat of negativity in partisan media outlets have given many people the erroneous impression that the economy is going straight to hell. I'm reminded of these Grateful Dead lyrics. I may be going to hell in a bucket, babe, but at least I'm enjoying the ride. Sure, Americans say they hate the economy, but they're spending as if they love the economy. Record retail sales during the 2021 holiday season helped fuel a Santa Claus rally. The momentum is set to carry over into the new year. Goldman Sachs' latest forecast calls for U.S. gross domestic product to grow 3.8% on a full-year basis in 2022. The consensus on Wall Street also calls for inflation to eventually moderate in 2022 as supply chain dislocations get ironed out. Stocks are on pace for another strong year, but gains aren't likely to be as robust as they were in 2021. The Fed's tightening this year is likely to prove a headwind, but not a bull market killer. Corporate earnings growth is poised to continue its winning streak, but at a slower level. The biggest issue in the coming months for investors will be inflation and the Fed's response to it. But maybe you're looking for an investment approach that reaps big profits regardless of inflationary pressures, shifts in Fed policy, or the path of the pandemic. I suggest you visit the URL that you can see on your screen right now. Well, that does it for now. Thanks for watching. I'm John Prasinos, and I'm wishing you a Happy New Year.